And good afternoon. Welcome into Market Talk for Wednesday, March 17th. A happy St. Patrick's Day to you and yours. Thank you for joining us here, as always, for another edition of the show. MarketTalkAg.com. That is our home on the web. That is where you can find us at MarketTalkAg.com. Facebook, Twitter, Instagram. It is all at Market Talk Ag as well. I'm your host, Jesse Allen. Great to have you here with us once again, and an interesting market day. Let's talk all about it, and let's bring in our good friend Mike Zuzolo with Global Commodity Analytics joining us here for another Wednesday. And Mike, good afternoon. We were a little lower, so maybe we're making progress on our down day Wednesday with Mike.
Yeah, we were split, and you and I had the little beanie dolls out. We were rubbing their heads and everything, trying to keep the markets up on a Wednesday.
Yeah, doing our best to keep the markets up on a Wednesday. I think I want to lead and ask you about these Chinese corn purchases of old crop here, and close to 95 million bushels in the last 2 days. And from what I saw, it looked like that was an April delivery as well. What do you make of these new purchases, Mike?
This is an interesting dynamic because we've talked about a lot how the demand going forward for the corn looks a lot better than the demand going forward for the soybeans. Two reasons for that. One is the South American crop. It's clear at this point to me, even with my soybean production for Brazil being below 130 million tons, and the trade and USDA and some official people down in Brazil at 133 to 135. Even with that, they've got a decent crop. It's going to be a decent crop because we had 126 million tons last year, Jesse. Corn, you can't say that, I don't think. And so between Argentina and Brazil combined, you've got a real issue with having suppliers out there to compete with the United States. You throw Ukraine into that pile, and they've been the big boy on the block when it comes to the central part of the world and taking a lot of our business, and even to China recently. You've got three major suppliers that are probably not going to be bothering us much at all in the next 2 to 3 months. And I think this adds to the idea that the corn has a better demand base because of less supply. I think the other thing goes back to is the cheapness of the corn, both in terms of the cash market and the futures market. And what I mean by that is you've got in China, their futures price is essentially $11 a bushel compared to our price. And then you look at it from another perspective. You've got November beans, even after the price break we've had the past couple of days, still sitting around that 12.25 to 12.40 level. And yet December corn can't do any better than hold into that 480, 475 level. So you're keeping a 2.6 ratio, which is very high in favor of soybeans, even given these kind of export numbers. And what I'm really driving into in this week's program is the idea is that the market, I think, is a little bit behind in their mindset, and they're not looking at the current fundamentals that you and I are talking about today, mainly because the stocks report is supposed to be so much more bullish for the beans in the trade's mind. And I think the trade's more worried about soybean acres going down or corn acres probably more likely going up. That estimate that came out from Reuters a few days ago of corn going up to 92.8, that surprised me. I'm in the exact opposite camp. I feel like it's going to be hard to hold on to corn acres given what we've had the last month and given how the USDA tends to use that ratio when they come out with their Feb projections. And so I think the March number could be quite different, but I think the trade's got to have to see those two numbers, the grain stocks and the acreage numbers, before they're going to give the corn its due. It's say, if I continue to say one thing to clients and subscribers, it's that if we're going to be at 12.50 November beans, we need to be closer to $5 December corn.
And that's something I think we're going to be watching. We look at those planting intentions that are going to be coming up here in a couple of weeks from USDA. And then too, I wonder how much we actually ship to China. I think that's what a lot of people are considering right now, is that, they're making the sales, but then how much do we actually end up shipping? And I think with some of these sales being for, an April delivery, time will tell us here in short order. Plus with spring planting coming up in the U.S., I think that will tell us a lot in short order here, as there's still maybe some weather concerns out there for U.S. Here for the summer growing season.
Yeah, and I think one other thing that I think maybe earlier this week, obviously the wheat is a whole different story when it comes to the fundamentals that and how much they've changed. And I talked about that last week and how those models were looking much wetter going into the end of the week last week, and that sure
Mhm.
enough did happen. So wheat's definitely, in my opinion, a pressure valve that is keeping pressure on the corn market. But even the planting progress, getting caught up to the 5-year average in Texas, I believe it's up to 12% if I remember correctly. The corn planting there in Texas is getting to that level at this point, and Louisiana and Mississippi are starting to get moving on it as well. These are the kind of things that I think maybe have kept the corn down a little bit more this week, in addition to what we've already talked about. But I think that the issue at hand really becomes the domestic market is probably going to need to vie for the balance of the corn supplies going into the springtime, even after we get safely planted. And so, what I've told clients this week who have old crop corn, which I have none left, and have old crop beans, which I have none left, I'm much more worried about the old crop soybeans breaking in the cash market with the futures because of the crush margins, because of China's ASF and their crush margins, than I am the corn market breaking. In other words, I think the cash corn market can hold up a lot better with improving and narrowing basis to offset the declining futures.
Mike, you shared some stuff with me this morning looking at kind of the historical side of corn and soy prices. Let's talk about that a little bit. I'm going to pull it up on the video screen, but can you maybe go into this a little bit and talk to us about some of these numbers and what you're seeing here on a historical perspective?
Yeah, this is a piece of just data points that I wanted to see exactly how November beans and December corn reacted to one another in terms of how they priced themselves in the month of March, given these last 12 or 13 years, and then how they price themselves given the month of April. And so the specific prices you see are the April moves from the opening in the 1st of April to the closing at the end of April. And you notice an interesting feature here. There are more frequent times that the corn closes higher. 8 out of the last 13 years, December corn's been able to close higher in the month of April. And you notice that the month of March really had very little to do with that. In the soybeans, the month of April, you can only count about 6 times out of the last 13 years, or 6 Aprils out of the last 13 months of April, that you've been able to close higher in that month. And what I did then also was to look at the March closes and try and line up for each of them. And that's what you see in the green when you had a March close higher and then you had an April close higher. And I found it very interesting that you only had 4 times a piece in each of those complexes that both March and April closes were higher from their opening prices. And they're all different except for 2014. And so corn and beans really can divorce themselves during this time period, Jesse. And I think that's really important to that earlier point about the bean corn ratio right now. And when I look at 2008, because that's my model year, that's the top number in 2008, you see that we closed higher in the month of March for 2008 for December corn, lower in the month of March 2008 for November beans. And that closed lower in the month of March for beans was massive. It was $3 to $4 in terms of a break lower. Then we came back in April and closed about $1.40 higher in the month for November beans for April. Whereas with corn, December corn closed higher in 2008, both in the month of March and in the month of April. And boy, they really did a good job in the month of April, closing 45.5 cents higher. This was a big deal to me because of the fact that we saw such a big premium in the soybeans back then. We saw a soy oil rally back then. And I think we could be geared up for kind of a similar price action, especially if we stay wet as we walk into the April time period. And USDA, if they don't give us any kind of a strange number with those great big corn acres that the trade's worried about.
Well, great insight as always, Mike. And I know that's just some of the research folks can get when they work with you, and check out all the great stuff you have on your website, globalcomresearch.com. Uh, any new thoughts this week for producers? Looking at marketing any of that new crop quarter beans here. Would it seem like the story is probably kind of the same? Leave some room for some ownership over the top, kind of leave that top side open. Any thoughts to that, or any new advice for people this week with their marketing plan?
No, I think it's pretty much same situation, different week. I will say though that the numbers, the firmness of the inflationary pressures, the idea that we have a commodity super cycle, I said I didn't buy into last week. That's only gathered more steam this week, Jesse, and that's mainly because of the talk of the Biden administration potentially coming out with an infrastructure spending bill, which would be very inflationary. Fiscal spending on infrastructure that would go directly into the real economy. That would be wonderful. But we're hearing, we don't know this for a fact, but we're hearing that would be compensated or paid for in part by tax increases, especially business taxes, and maybe taking away some of the capital gains benefits for companies and for individuals. This would be, I think, very deflationary. And so the mindset I had back during the November election was when I looked at all the policy angles that I could look at: energy, geopolitics, China, taxes, interest rates. It seemed to me that a new Trump administration or a second Trump administration would be dollar weak, in other words, inflationary. It seems like I'm on track with the idea that the Biden administration mindset and their policies are mostly deflationary at this stage. It's early days, so I don't know for a fact, but I don't buy into that commodity super cycle with some of this recent data. One last point is we just got the weekly rail car loadings from the AAR. They suggest, except for grains, they suggest we are not inflationary right now, that the price inflation we're feeling is due to really poor supply chain issues that are left over from the pandemic and just tight raw material prices, supplies, I should say. Those raw material stocks being so tight are raising raw material prices. Those are then going to be passed on to the consumer. So I think it's still like a lot like the late 1970s, early 1980s. Year to date, we're up 27% in grain carloads, and it's really nice to see that. But every other category except the intermodal container units is down, and in some cases down hard. Motor vehicle and parts still down 14%. Non-metallic metals down 17% year to date. So these are not inflationary numbers. I think that's one of the things I'll just keep on top of each week we talk, because it's going to be such an important driver to whether the funds come in and buy commodities, especially grains and livestock.
And that's a great point there. And I always appreciate insight like that when we talk, Mike. It's very curious when you really look through the tea leaves, so to speak. You can see all these different things and factor it into the market trade. Let's look at the wheat market here real briefly. I know you're in the Central Plains, you're in Kansas, getting a lot of rain and moisture in that hard red winter wheat belt. We saw wheat futures down slightly today. Any thoughts on the wheat market here this week?
Well, it's going to be very tough for the wheat to find support until we get our demand base back. And I think that's where we either need another USDA report to support the idea that global stocks are still going down, or we're just going to have to wait for some exports to be improving, because it does look as though, to me, Jesse, we've got a real shift in the conditions. Even though I'm not in the hard red wheat belt, I'm literally on the Missouri River in Atchison, Kansas here. And so I literally can look across the yard and see the Missouri border. And so we're still in corn and bean country for the most part, but I've got enough clients out in the hard red wheat belt that they are suggesting to me that even with their rough patches that they've had over the winter time, their freeze damage is probably less than what they expected. And that is in part because of all these rains that they've been able to get. And the key with wheat, I learned a long time ago, is you can have a lot of bare spots, but it can tiller out and fill in if you've got the precip and if you've got the stand. And it looks like we have a better stand than what we would have had a week ago. So I unfortunately feel as though the wheat is not going to be the leader to the upside here as we go into the springtime. So that puts me into more of a defensive posture that corn and beans are going to be more on their own.
You talked a little bit about macro factors there with inflation, deflationary tendencies, et cetera. Any other outside macro factors we need to watch here this week relating to the grain market?
Yeah, maybe not something that will come on board right away in terms of this next week, but I thought it was an interesting piece of fundamental news when the Department of Energy stated this week that they don't see gasoline consumption here in the United States getting back to the pre-COVID levels because of demand and because of price and because of changing towards a green energy mindset. This is something we have to keep in mind on the ethanol market. We probably have less to worry about in the biodiesel sphere because that looks like it's going to be more embraced by the clean energy, climate change people at this stage of the game. Having said that, we had some really out of this world, out of the park type demand numbers for the ethanol. We saw the ethanol demand increase 3.5%. Supplies dropped about 3.5%. That net shift to a 7% gain is really nice to see when that's one of the weakest segments of the corn demand market potentially. So this again goes back to the idea that I think we're going to need to hold on to more stocks of old crop corn and not let it get out to the export market to China. That means rationing the demand somewhere, and that's going to be through higher prices unless USDA gives us a real weird, out of this world big stocks number, or they really do come in with a big acreage number.
Let's flip our conversation to livestock, Mike. And I wish I had the sound of a squealing hog to play as a sound effect or a victory bell, so to speak. But this hog market, it seems like St. Patrick's Day was a good day again for the hog market. We broke some of that psychological resistance on Tuesday in the summer months, over $100 now with those hog futures. And really, it just seems like this hog market continues to churn higher. What are your thoughts with where the hog market is at here after today?
Yeah, I think retail prices are starting to literally take hold here and cut out the featuring. I saw the beef feature activity by USDA last Friday was up, I think, double digits. I want to say some of the activity advertisements on the featuring by retailers was in the 20s percentage level higher than what it had been over the course of the last 4 weeks. And so I think beef is really going to start getting its market share. And I think it's going to really start to take away from the pork side of the equation at the retail meat counter. The other thing that I think, and this is where I'm hedging, we talked about getting above $100 or at $100 and start hedging. I want to be hedged at this point. If I worked for a fair to finish hog producer, which they're very thin and far between at this stage of the game in our industry, but if I worked with one, I would say get all of your summer marketings hedged here at this point, because I think one of the key factors that's led this hog market higher, not just has been the funds, but it's been the belly market. And this is a very counter-seasonal, odd move for the bellies to be going this sharply higher, especially as we go into summer or early summer. This is not quite BLT season yet. And that seasonal seems a little bit far off in the distance for the kind of belly prices we're looking at right now. So I had a call from a client today, and he said, I got a guy that says buy hogs. It's $100 in June. It's gone to $125. I said, that may be, if you want to put the order in, I'll write it, but I'm not participating in that mindset at all. I think the hogs are getting old in terms of the rally potential, and that as the April goes off the board, it's not uncommon in my experience that as April hogs go off the board, you lose your rocket fuel to the upside when that May takes over as lead month. So just keep that in mind as you're looking at these prices.
Let's talk cattle, and we're looking at possibly more demand here with more folks getting vaccinated, restaurant demand coming back, summer grilling season, etc. Cattle had a nice day on Wednesday, nice move to the upside. Still, though, feedlot country, we're trying to break out of this price rut. We're seeing some sales at 114. We got that Fed Cattle Exchange auction in on Wednesday morning. And bids are still out there around 114. We're getting asking prices 116, 117 in the South, and we're just not breaking out of this sideways range quite yet, it seems. But do you think that could come later this week if Packers hold out? What are you thinking with this cattle market right now?
Yeah, I mean, I think the cattle are so strongly tied to the hogs right now, Jesse. Not only do they have such a sharp correlation or relationship with them, like we talked about last week, but that cattle hog spread's now gotten down to $25. That's about a 6-month low or 8-month low at this stage. And I think this is where cattle are not going to fight the hogs going higher at this point because that spread is so narrow. And so whatever hogs go up, I think the cattle will want to try and keep pace with that. I think the issue with that cattle market continues to be 114 and a half was a good number. It was a positive number compared to last week, so the trade like that. The loss of 5 pounds off dressed weights was nice to see. We're down 1.5% year to date production for beef. We're down 2.2, I think, percent production down on pork. These are good numbers, and it supports the idea that breaks will be bought as long as the hogs are going higher. But I can't be a bull in the cattle market right now because I see too many numbers coming ahead of us in terms of marketings. And I've seen on the Oklahoma City feeder auction this week a lot of grass feeders, a lot of interest on grass feeder. In other words, a lot of grass feeders are coming to the market right now, and this is the time of the year that they do in this March, April time period, and that stocker country really gets busy. So I don't think we have a lot of upside in the fat cattle right now. I can't think that the cash market is really going to stay really that much stronger than it already has been this week. To answer your question, I guess the last thing, I'll kind of leave you with is the idea that with the futures market still premium to the cash, and then watching those back end contracts like the August fats rally pretty nicely, I'm putting open orders in with clients to hedge August fat cattle up around that 122 level, because I think that's where you can make some good money. And if you're wrong hedging, you can't go broke making a profit.
Well, Mike, all great insight as always here on another Wednesday market talk. And I know folks can reach out to you via your website, globalcomresearch.com. That's globalcomresearch.com. Com with two M's there in the middle. And they could sign up for a trial of your newsletter and get a lot of great research and insight working with you, can't they?
Yes, they can. And the new branch office, Carrie Heidish out of Nashville, just put out a new blog post on refinancing and looking at loan costs and interest rates. Really nice piece on the blog. So take a look at that as well.
Globalcomresearch.com is where you can find out more. And Mike, appreciate the time as always. Have a great week, and we'll talk next week.
Thanks, Jesse. You have a great week too, sir.
Mike Zuzolo with Global Commodity Analytics joining us here today on Market Talk, and that's going to do it for our St. Patrick's Day edition of the show. Find more online, markettalkag.com. This has been the Wednesday edition, March 17th. I'm Jesse Allen, wishing you a great afternoon.